Yes, we're in a bear market territory now for the S&P, for the NASDAQ, for the Dow. That doesn't mean, guys, we have to start, or we can't start thinking ahead a little bit and start planning ahead. Yes, using our 8 balls maybe even to maybe start to nibble at positions, longer term positions in this video. We'll get to it eventually. In this video, guys, we're going to talk a little bit about stocks that we like on the long term. We're talking time frame out of the horizon at this point. Let's jump into a few ideas here for long-term buys.
A lot of times it would be easy. Like I could just say like AMD and then hang up the phone here or something like that. But I'd rather go into, I want to talk 2 names, but it doesn't really matter. I'll just pick Caterpillar. I think whether it's Caterpillar or John Deere, it's kind of the same concept here, where I understand you have that R word lingering, right? But I want a solid company with a proven track record of having a solid market that's addressable, that I think is going nowhere. And the truth of the matter is, I don't think when it comes to agriculture, when it comes to infrastructure, that we're not gonna have a need for these things, especially in the U.S., and that there isn't gonna be some potential growth there. Now, is there some downside risk? Neither one of these trades, like in the low teens on the PE, neither one of them is single digits at this point, so I can't pretend as if it's super cheap. But I can tell you they both pay a healthy dividend. They have held up relatively well, while other names are sitting at some of their yearly lows. Something like a Caterpillar is a good 5 to 7% above that. Deere a little bit dissimilar, but I think you've been seeing some signs of strength overall. And I just feel like this is where you might start to dollar cost average, because if I have to go out and project who's going to be around and who's going to be making money and who's going to be generating cash for the next 4 or 5 years, I think those are 2 names I feel confident about. Now, do we have to dodge some bullets when it comes to earnings? Maybe some earnings revisions to the downside. Maybe the E on the PE starts to come in a little bit more. Sure, but I feel a little bit better about those 2 names than I would about some of those like tech names. And we've thrown those names out there before. Like I said, I could tell you AMD, but I just feel like Caterpillar, John Deere, those work for me. And I think you got to start nibbling in those types of names, a little bit more defensive.
Not beat down so much yet, and I think that's obviously a good sign for that. I'm going to go with something a little more aggressive. We were talking about longer term time frames right now, and like I own the stock. It doesn't mean that I necessarily think that at these levels it can't go lower, but my stock's going to be welcome to Mickey Mouse's neighborhood, and I think we can go with Disney a little bit here. And the reason why is quite simple. It's down 40% this year alone. So $155 down to $94. So it's not been a great ride, obviously, for Disney. But right now you're able to pick it up at basically all-time low forward PEs, right? The average forward PE over the last 5 years for Disney was 29.5. Right now you're at 17.5 for Disney. But the thing about this is, remember, don't add us, don't do anything like this. What we're trying to do is give you some ideas here for moving forward, right? And I think that if you do have a time frame of 2-3 years, when hopefully, we're back into a little bit more stable environment as far as the Fed is concerned and travel is concerned and just getting back to business, I think Disney has that chance. Not only that, they are expecting to go between 230 to 260 million subscribers by the end of 2024. How are they going to do that with just Disney? Well, the thing is, they have Disney Plus, they have Hulu, they have ESPN as well. So I feel like there is some potential there, and I know that there's going to be some consolidation in the streaming side of things, and I just don't think that Disney's going anywhere. They may be the ones scooping up some other properties to add to some of their content. Plus, remember, they have the big blockbusters as well. Don't forget about some of the names that they have: Star Wars, Marvel, everything else, all the princesses, everything that they have. They could come up with new products, new areas to go. Plus, they have a cruise line business. They have the hotel business there in Orlando and California. Plus, all through China is going to get reopened and stuff like that. So throughout Europe, Disney World Paris is there as well. Their subs actually grew 32% in second quarter as far as streaming is concerned. So I think you have to really ignore some of these short term, which I don't know how short term, maybe to 2024, short term sort of headwinds that a lot of these companies are dealing with. And although obviously it's going up since we started talking about it, I think Disney down here at these lows with the current PE that it has, I feel like in 3-4 years, Brendan, you're not going to have too many issues here owning Disney shares.
I'm going to take a little bit of a different approach here, and I'm going to come north of the border and talk to our Canadian friends a little bit and talk about Canadian Banc Corp, which is listed on the TSX here in Toronto. BK is the symbol. This is a daily chart of Canadian Banc Corp. This operates as a fund, and essentially what they do is they hold all of the major Canadian banks. If you look at the bottom of the screen here, they pay a monthly dividend. I mean, the market's down 33% from the highs. This is down 17% from the highs. So if you want exposure, if you're in Canada, have access to Canadian markets, you like the big banks, you want exposure to the big banks, heck, you like a monthly dividend, check out BK as well. I've already started nibbling on that one, guys. So just so everyone is aware. A couple of great ideas, though, for long-term buys.